Um, and so now we are recording. Like I said, my name is Grace Spulak. I'm the director of the New Mexico Commission on Access to Justice, and we are here with Mark Pustay, who is a managing attorney at New Mexico South Broadway, or
United South Broadway.
United South Broadway, sorry about that, corporation. And he represents homeowners who have been sued for foreclosure in the New Mexico courts. The United South Broadway Corporation Foreclosure Defense Project was named an outstanding program of 2012 by the New Mexico State Bar. They also provide counseling for homeowners who are in foreclosure to help them figure out how to avoid similar circumstances in the future. And so we want to thank Mark for being here with us today. We also have Juan Abeta, who is working with the Commission on Access to Justice to help us with our community integration work. And Juan is going to be helping me monitor your questions today. We're doing this webinar on the Zoom webinar platform, so it's a little different than some of the other webinars we've done. So I want to make sure everyone knows how to communicate with us. And so if you look at the bottom of your screen, you may have to hover over it with your mouse. There should be a Q&A button. And so if you want to enter your questions in the question and answer box there, and then Juan and I will be monitoring them. We'll make sure that Mark gets them answered as he goes through his presentation. And so with that, I am going to turn it over to Mark.
Thanks, Grace. I'll admit, I really wanted to open today's webinar with that white kitten filter. I don't know if anybody's seen the lawyer cat video from yesterday. If you haven't, make sure to watch it. It's actually really funny. It's only about a minute long, but I got to admit, I was really tempted to open in that, but nevertheless, here I am. You get to see my smiling face. Thank you very much for being a part of this today. I want to start by saying I really appreciate all the work that everybody who's part of this webinar is doing, be it Grace, be it Juan, and be it anybody who's attending virtually this webinar. I know all of you are trying to do whatever you can to help those who are most vulnerable during this really difficult time. And when we talk about vulnerability, it's obviously not just health vulnerability, but it's financial vulnerability as well. And that's obviously something that we're going to be talking about here today. But I want to just take a moment to thank you for all your efforts that you've already done, the efforts that you're doing now, and that the efforts that you're going to continue to do in the future. And if there's any way that United South Broadway can support those, please let us know. With that, go ahead and let's see here. Go ahead and here. All right, so it should be screen sharing, and let's go ahead and get started. All right, so obviously, let's go ahead and address the elephant in the room. The COVID-19 pandemic is the elephant in the room when it comes to foreclosures, evictions, or any sort of financial situation that somebody particularly low income is facing right now. Let's go ahead. The largest question I think looming over all of us when it comes to foreclosure is there going to be a coming foreclosure crisis? And if so, how bad is it going to be? I think the first question can be reasonably answered in the affirmative. Yes, there is a coming foreclosure crisis. Exactly how bad it's going to be is still yet to be determined. I do believe that we're going to see definitely elevated foreclosures here, certainly over the next 2 to 3 years, elevated compared to the last 2 to 3. We're already seeing some of the data during the pandemic already. So the ones that seem to me the most telling are the early default rates are the highest they've been in 21 years as of April of last year. Now that's obviously the early days of the pandemic, but that 21-year period also includes the 2008 mortgage crisis, which we're going to talk about here in a little bit. Unemployment rate was, the seasonally adjusted unemployment rate for June was up almost 100% from the year before. Obviously, people losing jobs, they're not going to have the money to be able to pay for things like the roof over their heads. The forbearance rates skyrocketed early in the COVID-19 period. In early March, to give you an idea, there was only about 0.25% of all loans that were considered in a forbearance period. We'll talk about exactly what a forbearance period is, but just know that just before the pandemic, we're looking at just about 0.25% in forbearance. And then within the next 3 months or so, approximately 8.47% of all loans across the country were now in forbearance. That's a massive jump in such a short period of time. The first set of forbearances, by the way, if they haven't been extended, actually did begin to expire in the fall of last year. With that, the extension of the initial request period, there are going to be some forbearances that expire in fall 2020 and some that last as long as spring 2022. As I noted, I don't think that any of us know exactly how bad this coming foreclosure crisis is going to be, but I do believe that the data suggests that we're going to see several spikes in foreclosure related to the end of certain forbearance periods. And I do believe that we can reasonably say, with a lot of confidence, by the way, that over the next 2 to 3 years, we're going to see a significantly elevated rate of foreclosure. I sort of briefly talked about the mortgage crisis, and I think it's important context to consider because there's obviously a clear parallel to what we're going through now. Now, look, it's not a perfect parallel. The reasons for the mortgage crisis between 2006 and about 2009 were pretty varied. They were a lot different than what's going on now. There was a lot of endemic, systemic issues that were ongoing, but to give you a sense, in 2006, only about 965,000 loans across the country were in foreclosure. And as you can see, over the next 3 years, that increased by nearly 300%, right? And so I think you're going to see a similar rate. I think you're going to see a similar rise in foreclosures over the course of an extended period of time like this. Again, it's not exactly the same. There were a lot of different things that, I think the deregulation that led to some of these reckless lending practices was probably one of the biggest contributing factors. And it's something that after the crisis, after the bubble burst, there was a lot of emphasis to address directly. How did we address that directly? Well, at the federal level, the Consumer Financial Protection Bureau issued a number of new regulations that were aimed directly at mortgage lending. But at the state level, there were a number of important amendments made to the Home Loan Protection Act. Now, the Home Loan Protection Act predated that housing crisis, but there were a number of important amendments that actually helped address some of the issues that came out from the mortgage crisis. In general, the Home Loan Protection Act regulates lending practices, which include some high-cost home loans. And for any practitioners, figuring out exactly what a high-cost home loan can require a little bit of arithmetic, which some of us are better at than others. But generally, they're defined as anything that exceeds the rate or points fees threshold that's included in the HLPA. Again, it takes a little bit of work to figure out whether or not a certain home loan is a high-cost home loan, but typically you'll see certain red flags, certainly an excessive interest rate. And if you have the opportunity to look at a borrower's closing documents, you can really tell from the fees that were assessed at closing whether or not this might be something that exceeds that points or fees threshold. Another big thing that lenders have to do as a result of the Home Loan Protection Act is that they have to document and evaluate a borrower's reasonable ability to repay the loan. Again, this directly addresses those issues about recklessness in home lending. Part of the recklessness was that lenders weren't paying very close attention to whether or not somebody could reasonably repay the loan on a long-term basis. The emphasis was to try to get the loan closed and to get somebody into the home. The long term was never considered at that point. So the Home Loan Protection Act addresses that. It does impose caps on late fees. The caps that imposed were a late fee can't be more than 5% of the outstanding principal. The late fee can't kick in until it's at least 15 days late. And a late fee can only be assessed once for every late payment. The other thing it does, and that I think this is an important one, is that it does prohibit negatively amortizing loans. We still see a few of these every once in a while. I mean, I apologize. There's the other parenthesis there missing bothers me from a detail standpoint, but substantively, negatively amortizing loans are real dangerous. Somebody's in a negatively amortized loan when they're paying every month and yet the principal never reduces. Essentially, they're running in place. And even worse, they're actually kind of running backwards. The idea behind paying a loan and having a loan schedule is that if you pay the loan every month in full, you're supposed to be able to knock down the principal on the payment schedule that's agreed upon. There are negatively amortizing loans that are out there that put a borrower farther behind the more money that they put in. And obviously that's a real dangerous situation. The Home Loan Protection Act does prohibit those. It also requires, for foreclosure purposes, certain notices to the borrower upon default. The specifics are included in the Home Loan Protection Act, and they can really help you if you're helping somebody who might be starting to fall behind. But if you want the specifics, you can look at it, but just know that the Home Loan Protection Act does require certain notices upon default. And by the way, an opportunity to cure. So, let's go back to sort of some basics, because I promise that some of these basics might seem very elementary, but I think it makes a lot more sense when we get to some of the more extensive concepts about foreclosure. And I understand that a lot of people may be coming at this from different points in their experience. Why might somebody get a home loan? Well, everybody knows the idea of getting a home loan to purchase a home. That's the one that I think everybody runs to, but there are other reasons that somebody might get a home loan. It might be to refinance an existing home loan. You're seeing a lot of refinances right now, people trying to cash in on lower interest rates. Some people who are trying to get a quicker payoff. Sometimes people will get a home loan to pay for other expenses through a line of credit. That might mean that they had repairs that they wanted to do with a home. We've had clients who got a home loan on a home that was already paid off because let's say that the roof needed to be replaced or the bathroom needed to be finished. In those loans, you'll typically see a draw period and then a repayment period. The draw period is a period of time under which the borrower can actually take money out of that line of credit. And then there is a repayment period that kicks in afterwards that actually starts the time that the borrower has to repay. A lot of borrowers don't really understand exactly when the repayment period kicks in. And so that can mean that they default on their loan very early in that repayment period. Finally, a lot of times somebody will get a home loan to cash in on existing equity in order to help them in retirement. And this is where you see reverse mortgages the most. Somebody who, let's say, has paid off their loan entirely. They can cash in on whatever remaining equity they may have with on the agreement that if the home is no longer their primary address, so that could be for any of a number of reasons, including the borrower's passing away, then the agreement is that title will revert to the lending company, right? So if somebody does get a home loan, let's start with the basic concepts of what a home loan is. A home loan really boils down to, there's a lot of documents that are signed at closing. And closings can take quite a period of time. The two most important documents, though, and the documents that are really the primary focus in foreclosure, are the promissory note and the mortgage itself. Each borrower has to sign a promissory note and a mortgage at closing. Now, each of these documents have separate functions. Let's focus on the promissory note for a second. The promissory note itself is the evidence of the borrower's personal promise to repay the debt with interest within a certain period of time. So that might be 15 years, it might be 30 years, it might be some other period of time. Now, anyone who signs the promissory note is personally liable for the debt, and only those who sign the promissory note are personally liable for the debt. If you've done any work in foreclosure, or even if you haven't, you might get questions from clients that say, hey, I understand the home loan's in foreclosure. I'm scared. I don't have the money to be able to pay for this. Maybe this was our grandfather's home. Maybe this was my brother's home or my wife's home. I don't want to be personally liable for the debt. Only those who sign the promissory note are personally liable for the debt, okay? But anyone who does sign it is personally liable for the debt. So when all the borrowers, let's say, who signed the promissory note pass away, whether it's one borrower, two borrowers, or others, then there's nobody left who is personally liable for the debt, okay? And so the successors in interest are not going to be personally liable for that debt unless they assume the loan, and that's a separate process that they have to apply for and be approved by the lender. The other document is the mortgage, and the mortgage is the evidence that the title to the home is offered as security for the repayment, okay? I mean, and the mortgage is the document that says, hey, if you fall behind, we can take your home. Now, every once in a while, you'll see somebody who signs the mortgage, but not the note, okay? There's a very specific reason for why somebody would do that. If somebody signs the mortgage, they're pledging their title as security for the loan, even if they did not sign the promissory note. So what that could mean, okay? Take, for example, a partnership, boyfriend, girlfriend, husband, wife, anything like that. And one of the two has sufficient credit to get a loan, but the other doesn't. Or maybe the other's credit might bring down the eligibility for the loan. Under those circumstances, the person who has the good credit, the credit sufficient to qualify for the loan, would sign the promissory note because they're the one that ultimately makes the deal with the bank to repay the loan. They're the one that the bank has approved for such repayment. The other partner would have to sign the mortgage as well because that person, especially in a husband-wife situation, may have a claim to that home. It may be as an official title, or it may be as a result of some sort of joint ownership in some other way. So the bank is sort of hedging their bets. They want to make sure that everybody who has any sort of ability to have any sort of title to the home signs the mortgage so that they know that if they foreclose on the home, they're doing whatever they can to ensure that they can clear title as well as they possibly could. If you have access to closing documents, I would encourage you to review them for any origination claims. This would include the settlement statement in particular. Origination claims are getting harder and harder to litigate, but they can be litigated, especially if you see a loan that you believe is particularly predatory. Now, what's your initial review? If you're looking at somebody on a foreclosure case, what are the first documents I need to be looking at? First things first, you look to the promissory note for the basic loan details. You look for the date of the note, take note of what the original balance is, who the original lender was, what the interest rate, importantly, who's personally liable on the debt. Are there endorsements or are there allonges? Okay, an endorsement is basically, typically a stamp, and allonge is actually attached to the original note itself. But endorsements or allonges are basically somebody who has the ability to enforce payment on the note, directing payment to someone else, okay? And as we all know, a lot of these loans are bought and sold fairly freely. And so there will more than likely be an endorsement or an allonge that will sort of direct payment to a different party. Look to see if there have been any modifications. These can be really important. They're not always necessarily attached to a foreclosure complaint, even though they should be. And I think legally they're supposed to be. A modification changes the terms of the original note in some way. So that could be the date that the payments have to be made, that could be the interest rate, that could be the balance, any sort of material change in the terms of the note. Look to see if they have those modifications. I would also encourage you to look at the mortgage statement. That'll give you the most current loan information that you can have available. Now, they're not perfectly accurate. Let me make sure that that's very clear, particularly the amounts due. If somebody is is behind by a significant amount, let's say 6 months or more, the amount due line is going to be significantly large, and sometimes it's not always as accurate as we would like for it to be. But in general, the mortgage statement will tell you who the servicer is, what the current balance is, what the current interest rate is, the year-to-date payment history, so how much they've paid in the calendar year in principal and in escrow, and where the loan is current. If the loan's current, you're going to see whatever the next payment is that's going to be due. That's going to be the regular payment. If the loan's not current, it's going to be however far the loan is behind. So let's talk about the most important question you're going to get. What happens if I don't pay? Now, I want to take a moment to talk about there's a class of people who aren't necessarily fall under the foreclosure umbrella. There are people who, let's say, that are afraid of falling behind. Let's say they've made all their payments to now, but they're getting a little concerned whether or not maybe a check that they're relying upon is going to come within the next week. Maybe they're concerned about their job coming up. Okay, maybe there's some question that the job's going to be lost at some point. So they're trying to plan ahead. So wait, what happens if I don't pay? Whether I've already not paid or whether I'm not going to pay into the future. The very first thing they have to know is you don't have to move out, okay? A lot of people have a landlord-tenant way of thinking when it comes to foreclosure. And I understand why, but because in landlord-tenant, obviously, if you start to fall behind, you can be forced out of that home fairly quickly. Foreclosure is a much different process, as we're going to talk about here in a minute. So you don't have to move out. However, communicate with the servicer. Okay, I know that can be difficult and scary, and I know that sometimes the servicer can be intimidating or at times threatening. But the best thing you can do is communicate with the servicer, because it'll give you the most information as early as possible about what you can possibly do if you do fall behind. So let's say you missed your first payment, okay? First, the late fees are imposed, as we noted, no more than 5, and only once per payment. If you do start to fall more than once behind, you have to make 2 months of payments in order to catch up. I know that makes sense, but you have to understand a lot of borrowers, and some before they fall into foreclosure, have run consistently a month or 2 behind. And you're going to get a lot of borrowers. You're going to get some borrowers who will say to you, look, I made my payments every month. Okay, why I shouldn't be in foreclosure. I made my payments every month. A lot of times, those borrowers fell behind a year ago, maybe a year and a half ago, 6 months ago, at a time earlier. And it took them a little bit of time to get caught up. But when they're running a month or 2 behind, if they have one payment that's even late, or maybe 2 payments that are late, or if they miss an additional payment, they may hit that danger zone of 3 missed payments. And if they hit that danger zone of 3 missed payments, then the options available to the lender really expand. The lender can ultimately send a notice of default and the right to cure, and basically say, look, that right to cure can say, look, you have 30 days to pay us whatever we're owed right now, whatever the arrearage is on the loan. If you don't pay in that 30 days, your loan is hereby accelerated. Back in the day, they used to be calling the loan, right? So if you owe $100,000 total on the loan, guess what? Now you owe $100,000 right away. And if you don't pay that $100,000, we're going to send you to foreclosure. These early intervention requirements, by the way, the CFPB regulations, you can find them on the CFPB website and the e-regulations. It's really a great site. It's gotten much more user-friendly over the years. But at 12 CFR 1024-39 is where there are the certain early intervention loss mitigation requirements. So a servicer has to reach out to a borrower before foreclosure and must do certain things. So you can find those there. So if somebody does fall behind, then the best way that they're going to figure out a way to save this home is loss mitigation. We have a lot of clients who, on the one hand, it's flattering. They think that we as attorneys can basically move heaven and earth, and that we can spin some sort of legal magic that means that the bank has to give them their home without this loan. Anybody who's been a practitioner and who knows any sort of part about the foreclosure world knows that it doesn't work like that. 99.9% of these loans, if somebody's going to save their home, is going to come through the loss mitigation process. So I would strongly encourage any borrower to engage in as much loss mitigation as early as they possibly can. Loss mitigation is broadly defined. It's anything the servicer does to mitigate their losses on the loan. Okay, that loan, even if it's not being paid, even if it's been accelerated, continues to accrue interest every single day. So the bank believes that every single day they're losing on this loan. Okay, loss mitigation is anything to do to cut those losses. Okay, so that can include retention, which means the borrower keeps the home, and non-retention, which means the borrower doesn't keep the home. Most of the options you do have to apply for, and you do have to be reviewed by the servicer for. And the borrower can typically get the loss mitigation application from the servicer. All they have to do is request it. Certain federal regulations and certain state statutes and regulations require servicers to actually send loss mitigation applications, even if they're not requested. You'll actually get borrowers who will say, "Hey, I get one of these every month in the mail." There's a part of that that's good. The servicer's following what they're supposed to be doing, but sometimes it could be a consternation for certain clients. But just understand that they will receive those in the mail. These applications generally require financial information that's basically similar to the sort of financial information that they had to provide when they first got the loan. So pay stubs, award letters, bank statements. They have to write up a hardship letter that shows, hey, I'm behind, I'm suffering a hardship. Every once in a while, you'll have borrowers who get a little uneasy about what goes into the hardship letter. That's not something that can come into court as evidence against them. So they should feel free to explain their hardship. A utility bill to show residence, and then tax returns. A couple things. This will generally include anybody who has income in the household. Okay, so and by the way, that's probably a good thing for the borrower. What the borrower needs to do is the borrower needs to be able to show as much income as possible and as few expenses as possible, right? Because the servicer is looking at that borrower and saying, okay, look, the borrower wants another chance. Are we willing to give it to them? Well, how will we know if we're willing to give it to them? Well, can they right now afford payments that would pay off over time in a fully amortized loan what we're owed right now? Okay, and I think it needs to be described to borrowers in exactly that way, because you'll have a lot of borrowers will come to you and say, look, I've been behind for a year and a half. They sent me a loan modification, but the payments were more than the payments I had before. Why would they even send that? If I couldn't make those payments before, why do they think I can make these payments now? Remember, there's a year and a half of interest and fees. It might be attorney's fees and escrow. So that'll be the interest and the taxes, and all that collects. The borrower owes more today than they did before. Okay. And the question is not affordability back when they fell behind. The question is affordability now. Okay, so somebody may have experienced a financial hardship before, maybe their financial situation's improved, but if it looks to the bank that they can afford a particular payment, and affordability matrix has sort of shifted over the years. It generally runs between 30 and 40% of gross household income, but the question is, what can you afford now based on what's owed now? And that's the evaluation that the service is going to do. Putting together these applications can be frustrating. They can be time consuming, and they can be a little mystifying. Housing and Urban Development has trained housing counselors around the state to provide their services for free. United South Broadway has such housing counselors available, so I'll put a plug in for them. They are free regardless of income. Our legal services are limited in terms of income, but the housing counseling services are available to everybody regardless of income, and I would certainly encourage anybody who needs those services to contact our housing counseling department.
Sure, Mark, actually, I'm
Yeah.
sorry. I want to just to reemphasize that. So if someone has fallen behind, they want to apply for some of this loss mitigation, um, they can call that number you provided in the last slide and get some information about how to do that. Is that correct?
Yes, they can get information about how to do that. And they can also meet with somebody who can help them actually put together an application if they desire to do so. A housing counselor can advise a homeowner not just about sort of how to put together an application, but generally what options might be available and what they consist of, what they are, right? So those services, the services they can provide are pretty wide ranging. And these are the loss mitigation options generally. Um, the list isn't comprehensive, but these are the options you're going to see most often. Let's focus on the ones that allow a borrower to retain a home, to keep the home. The biggest one is a loan modification. Okay. Now, a loan modification, every once in a while, somebody will use the term refinance to talk about putting it back onto loans. Refinance and loan modification refer to very specific things. Okay, they're both changing the loan in some way. A refinance is basically a brand new loan that changes the interest rate. But refinances are generally available when the loan is up to date. A loan modification is generally available when the loan's behind and when it's in default. And a modification is actually taking the terms of an existing loan and changing them, modifying them, with the intent of putting the borrower back on regular payments. How will I know a modification is coming? Well, there's really two ways to apply for one. One, you can apply, there's two ways to get one. You can apply for one, and they can review your application to determine your affordability. Every once in a while, you'll get a borrower who says, I just got a modification out of thin air, or a trial payment plan out of thin air. A trial payment plan is basically a tryout. You get 3 months, 6 months of payments at a particular rate. And if you make those payments on time for those 3 months, 6 months, however long the TPP is, then you qualify for a permanent modification. If somebody receives one in the mail, first things first, verify that it's legit, that it's actually coming from their servicer. And if it is legit, yes, that's a legit offer, even though you didn't apply for it. The difference between ones you applied for and ones that you receive in the mail, we call those streamline modifications, is that the ones you applied for, the numbers are based on your affordability because they've taken a look at what it is you can afford now. The streamline loans are not. It's basically, hey, borrower, look, we've ran the numbers and we think $750 a month. If you can afford $750 a month, just so you know, we'd be willing to put you back onto regular payments. That's essentially what a streamline loan is. A couple things to pay attention to on trial payment plans. The borrower absolutely has to make sure that that payment is made in the calendar month that the payment is due. But encourage any borrowers to make sure those payments are made early, early in that month. And the second thing to watch out for is you really make sure that the borrower is watching out at the end of that trial payment plan period. Okay, so let's say somebody receives an offer this month, February, and the trial payments are for March, April, and May. Okay. After the payment is made in May, the borrower should really be on the lookout for permanent modification documents. They're extensive. A lot of times they need to be notarized. They need to be FedExed back, sometimes overnighted. The times that are required on that, a lot of times are times of the essence on those. And sometimes, especially if you're representing a client, they won't necessarily send it to you, even if there's an attorney on the other side. Sometimes they'll send it to the client. So make sure that the borrower understands to be on the lookout for those. But once that modification is signed, any foreclosure proceedings end, the person is put back into good graces, so to speak, on their loan, and everybody's happy. Reinstatement is you pay the arrearage, everything that's collected since the last payment. Obviously, if somebody is not too far behind, this could be a potential option. If somebody is, let's say, several years behind, this is going to be tougher to do. Forbearances, we're going to talk a lot about forbearances here in a few minutes. But a forbearance, just to explain what it is, it's a temporary pause in payments, okay? One thing I want to make sure people understand about forbearances, whether they're COVID-19 related forbearances or whether it's a non-COVID-19 related forbearance, they have to pay very close attention to what's required of them at the end of the forbearance period, okay? The COVID-19 forbearances, not all of them are being confirmed with actual written correspondence to the borrower, okay? So, sometimes they're just being confirmed orally, all right? And we'll talk about what happens at the end of those. But for the non-COVID-19 forbearances, or really any other type of forbearance you get, there is this idea among borrowers that if I get forbeared payments for 6 months, then at the end of that 6-month period, I just start my payments over again. And that's pretty rare. More often than not, those sorts of forbearances actually want a lump sum of those 6 months missed payments at the end of those 6 months, okay? And so we see a number of foreclosures that start about by somebody who was in a forbearance period, started making regular payments again, believing that that was the deal that they made, when in reality, they were supposed to make all those payments at once. So make sure that the borrower understands exactly what they're supposed to do. An assumption we talked about briefly is successor in interest takes over the loan. This can be, let's say the home has been in the family name for 50 years. Grandpa built the home after he came home from World War II. And when grandpa passes away, or maybe falls behind on the loan, somebody can come in and take over the obligations on the loan, okay? And now they're personally liable and grandpa no longer is. I just want to briefly talk about an at-risk extension. So reverse mortgages, there's loss mitigation on reverse mortgages is very different. And a lot of that's due to the unique nature of a reverse mortgage loan. They're not typically assumable, by the way, but an at-risk extension. Look, a lot of people think, well, how can you have a foreclosure on a reverse mortgage when borrowers are still alive? Isn't the idea supposed to be that the person has the home until they die? Well, that's one way. That's one thing that does happen in a reverse mortgage. But part of the deal with reverse mortgages that a lot of borrowers don't understand is that, yes, they get to keep the home, but they are responsible for taxes and insurance. And if they fall behind on taxes and insurance, the bank can file for foreclosure against two people who had a reverse mortgage and are still alive and still living in the home. The federal government offers these at-risk extensions, which basically give them more time, but they're only available for borrowers who are over 80. And all the borrowers on the loan have to be over 80 for them to qualify for that. So if you do have borrowers in a reverse mortgage who need a little bit of additional time, you can qualify for an at-risk extension that lasts for a year and can be extended at the end of that year. Let's talk about the non-retention ones. This can be a difficult conversation to have with the borrower. Look, for a lot of people, a house is not just a house, it's a home. And it's a home that holds a lot of meaning and significance to them. However, if somebody is in foreclosure, okay, they really probably need to consider their financial future. Some people may not really be too concerned about their financial future for various reasons, and that's fine for them. But to the extent possible, really encourage borrowers to make sure that emotion matters and it's important, but they do also need to evaluate their financial situation as objectively as possible. And if they can't afford this home, or if they're too far behind, or if the income just is not going to improve, it might be in their best interest to cut their losses. And these are a couple ways they can do that. One is a short sale. Basically, the borrower sells the property to someone else for less than what the borrower owes. So let's say a borrower owes $200,000 on the loan. They put the home up for sale. The realtor solicits bids. Someone comes in with the highest bid of $150,000. Now that's obviously not enough to pay off the full $200,000. but that bid can be submitted to the mortgage holder for review. And the question is whether or not the mortgage holder will accept, quote unquote, pennies on the dollar. Will the mortgage holder accept $150,000 as a short payoff of this $200,000? If they do accept it, the home goes to the buyer, the borrower's loan is closed out, any foreclosure proceedings end, and everyone moves on. A deed in lieu of foreclosure is actually a pretty simple concept. The basic idea is you give them the deed or the keys in exchange for dismissal. I feel awful. I mean, the best way the best analogy I can think of is, somebody points a gun and hey, your wallet or your life, and you just give them your wallet, right? That's kind of what a deed in lieu of foreclosure is. Somebody institutes foreclosure proceedings against you, and they'll say, look, we'll end them. You just agree to give us the house. And you say, okay, look, I'll take the house. I just want everything to end. That's what a deed in lieu of foreclosure is in general. Now, qualifying for it can be a little bit more difficult. If there are liens on the property, let's say there's a materialman's lien, or let's say there's a tax lien, or let's say there's a second mortgage, it can be a little bit more difficult to qualify for a deed in lieu. Sometimes servicers actually require the borrower to have tried to sell the property first and to have marketed it for at least 90 days. So just know that if those requirements come up as part of the deed in lieu process, those are pretty standard. There is also what's called stipulated in rem judgment. We'll talk a little bit about what in rem is as we get into what the foreclosure proceeding is like here in New Mexico. But the long and short of it is that they waive any deficiency in exchange for the home. Okay, they agree to forego any personal liability in exchange for the home. Right. This can be good for somebody who's significantly underwater on their home. Okay, and significantly underwater is somebody who owes far more on the home than the home is actually worth. So an example might be somebody owes $250,000 on a loan. The home is only worth $150,000. That loan is $100,000 underwater. If a foreclosure process were to happen and a foreclosure sale occurs, that property might sell for $150,000, but that only satisfies $150 of the $250,000 that are owed. There's still $100,000 left over. That's that deficiency. A stipulated in rem judgment is basically the bank saying, look, we're not going to get any personal judgment against you. We're not going to get any money judgment against you. We just want to wipe out your title and that you wouldn't owe anything more, but you do have to move out. They'll often offer these cash for keys as an incentive. I noted taxes in there. Technically, that deficiency amount is technically a forgiveness of debt for tax purposes. So a borrower may have tax consequences that come up for that tax year. So if you are advising a borrower, advise them to make sure they do talk to a tax professional so that they understand exactly what the consequences might be. And you can usually negotiate a cash for keys and a specific move out date, provided you leave the property in what's called broom swept condition. So broom swept condition is basically the condition that if you rented an apartment, you wanted your deposit back. That's broom swept condition. Okay. I really like this graphic. I'll tell you why. This is the foreclosure process in New Mexico. I know everything is small there, but that's because there's a lot of things that have to happen. If you see in the very sort of tiniest print over on the left is missed payment 1. And the tiniest print over on the farthest right is eviction. There's a lot of things that have to happen before somebody has to be evicted, okay? So if somebody falls behind on a missed payment, they don't have to move right away. This is one reason why foreclosure is so much different than landlord-tenant. And by the way, I certainly understand all the focus, the immediate focus on immediate relief during COVID has been on landlord-tenant for a good reason, because you can have court pleadings filed against you, and you can have a hearing within 30 days and you'd be gone. The foreclosure process is much longer. In fact, they won't even start doing anything until you've hit missed payment 3. Here's sort of another way of looking at it, but just in terms of time, just to give a general sense, these are just general timelines. You know, I wouldn't make a borrower rely upon them, but you know, generally things take a long period of time here. You know, a notice of acceleration default will only come after about 3 months. A bank will file for foreclosure no earlier than 4 months after the borrower falls behind. And then there's service, and then there's the initial pleadings, and then there's discovery, and then there's a summary judgment process, and then there's sale and all the post-sale stuff. And only then can the eviction process begin, okay? So there's a lot of time. There's a benefit to foreclosure in that there's a lot of time for a borrower to get their affairs in order, but the borrower really does need to take advantage of this time.
And so I just want to stop quickly and see if we have any questions. I know this is a lot of information. And so, like I said before, you can go ahead and put your questions in the Q&A box. Also, if you click on the participant button at the bottom of your screen, you hover over your name and click on more. There's an option to raise your hand too. So if you do that, and you'd rather do that than type your questions, I can unmute you. And so I just want to see if we have any questions about the stuff that Mark's already talked about before we go on.
Grace, real quickly, this is Mark.
Sure.
How much time do we have left?
We have 40 minutes.
Okay, good. All right, that's what I thought, so.
Yeah.
And obviously, if anything does pop up, and Grace, and if it's particularly relevant to something, go ahead and stop me and we can address it right away.
Okay.
The stuff that I'm about to go in is a little bit more timely. The foreclosure process itself here in New Mexico, one of the most important things you have to do early in the case is figure out what kind of mortgage loan do you have, because that's really gonna affect the way this loan is gonna go. And the biggest question is, do I have a federally backed mortgage? Do I have a government sponsored enterprise mortgage, or do I have a private lender mortgage? And this has always been an important question, but it's even more important in the age of COVID. And we're going to go ahead and explain why. But these are the federally backed mortgages. The top 3 are considered the federally backed mortgages: the FHAs, the VAs, and the USDAs, the quote unquote farm loans. The Fannie Mae and Freddie Mac are considered the government sponsored enterprise loans. And then you have basically everything else, private lenders, what we typically call conventional loans. So we've talked a little bit about forbearance. Let's talk about what a forbearance is before we talk about the COVID-19 relief that's available. As we know, forbearance is a temporary halt in payments for a defined period of time. Here's the most important thing: the payments are not forgiven. Okay, the borrower is still responsible for those payments. Okay, it's just they're not responsible now. The lender is not expecting a payment at the end of this month or at the beginning of next month. Okay, but it is for a defined period of time. The most important thing for a borrower to understand, as we noted, is what happens after the forbearance period. It does depend on the loan. It does depend on the program. It does depend on servicing guidelines. Let's talk just briefly about servicing guidelines. You're going to hear that a lot from servicers. The servicing guidelines say this. The servicing guidelines say that. They can be very difficult to get, okay? But essentially, the long and short of it is that every loan has certain guidelines and rules that apply to it that govern how the loan is supposed to be serviced and how loss mitigation is supposed to happen. Certain loans have servicing guidelines that say, hey, we're not going to approve any modification. Other loans have servicing guidelines that say approve as many modifications as you want, 1, 2, 10, it doesn't matter. I've seen as high as 11. I've seen as high as 11 modifications on a loan. But servicing guidelines are this sort of shadowy set of rules and regulations that sometimes you'll be able to get, sometimes you won't. Sometimes a servicer will say, oh, they're available on the SEC website, which is impossible to navigate. So Servicing guidelines are basically, for these purposes, just know that they're the rules that apply to the servicing of the loan. These are typically what you'll see at the end of a forbearance period. Lump sum is what you'll see most often on non-COVID related forbearance periods. So if it's a 6-month forbearance, and at the beginning of month 7, they're expecting 6 months of payments right away. Deferred payments, these are really good if you can get them. A deferred payment is basically, let's use that 6-month forbearance period I was discussing earlier. They take those 6 months of payments, okay, and they say, okay, well, look, you still have 20 years left on your loan. We're going to defer those 6 months of payments to the very end of the loan, okay? And those are payments that are going to be due upon maturity, okay? So if you pay the loan off earlier, it's due at that point. But if you pay according to the schedule, it's going to be due at the end of that payment schedule, okay? In which you will have one lump sum payment that amounts to those 6 months of missed payments under the forbearance plan. Now, deferred payments don't collect interest, okay? So that's a very important part of this. So that's why, in part, they're really good to get, okay? You push those payments off to the end, and what it does is that it gives the borrower a lot of time to maybe improve their credit, get a refinance, or sell the home. And then the deferred payments sort of all come out in the wash. A partial claim is like a deferred payment. It's essentially a deferred payment under the FHA program. The critical difference about a partial claim is that borrowers are only eligible for, basically the partial claim amount has a cap for each loan. Each loan has a cap as to how much of a partial claim they can take. It gives the servicer a little bit of flexibility to work on a loan modification, but that sort of, basically, you're sort of almost borrowing against the partial claim. So the partial claim, I believe in the numbers, I'm probably getting totally wrong, but I believe it's something like 30% of the original loan balance or something to that effect. And I always forget the number, but essentially, so if you have, let's say the 30% of your borrower's loan is $30,000. Well, they can take partial claims up to $30,000. So that might mean 2 partial claims, one of $20,000 and another of 10, but they can't go above that, okay? But they work like deferred payments. They're deferred to the end. The servicer gets certain relief from the federal government, but it does allow somebody to get back on payments. A repayment plan is basically, we pick a particular period of time, 6 months, a year, and the borrower will pay the regular payments plus a premium in order to catch up on those payments, okay? So if 6 months of payments, let's say, come out to $6,000, maybe over the next year, maybe the borrower has to pay an extra $500 every month in order to catch up those payments, okay? That's generally what a repayment plan is. Repayment plans under COVID are a little bit more flexible than they were pre-COVID. We'll talk about that in a second. But the biggest thing is generally you just don't restart payments at the end of that period. If a borrower can continue payments, it's generally good to do so. It's best if you don't have to get into this forbearance situation, but it can be a real godsend for those who actually need it.
And so Mark,
yeah.
just quickly, so we have a couple of questions, and the first I think you'll address when you talk a little bit more about the foreclosure process. But it's basically, so you talked about what happens if someone if someone is concerned about being kicked out before there's a foreclosure filing, before there's a sale. So what happens after the sale? What is kind of the timeline for people having to leave the home, and kind of are there things they can do? And so I'm guessing you're going to talk about that.
I am, but generally the timeline that's involved in that is after the sale, there are certain triggering events, okay? So first of all, the sale has to occur. The auctioneer named a special master, there's a title, has to write up a report of the sale. That report has to be approved. The court has 30 days to approve that report. After that, that report is approved, that begins a 30-day redemption period, which we'll talk about here in a second. But the real critical key is that the eviction process in a foreclosure cannot start until that redemption period has expired. Okay, and there's case law on this, but that is essentially when the eviction process can start, and it is a process. They do have to provide a notice to vacate that gives you at least 3 days, and only then can they go into court and actually file something seeking to get you out of the property. So there can be a really extended period of time after somebody actually has a sale or a judgment against them. I've seen this period last as long as 2 years. It just depends on how motivated the servicer is to act quickly.
Great, thanks. And then the other question is, what steps should a homeowner take when a stipulated judgment is offered with a waiver of deficiency? I know it's rare, but it does come up on occasion.
Sure. So a couple things that actually, stipulated judgment, it's interesting. One thing I would pay attention to is pay attention to specifically what it is that they're offering. Because this is one time in which the language does matter, and it matters greatly. There's a stipulated judgment, there's a stipulated in rem judgment, and then there's a stipulated judgment without deficiency or with a waived deficiency. A stipulated judgment is, I stipulate to whatever it is you want. Judgment, full judgment, okay? That's not necessarily always in the client's best interest. A stipulated in rem judgment is, for all intents and purposes, the same thing as a stipulated judgment with a waiver of deficiency. And those actually generally are available in most foreclosure cases. If you do get offered one, okay, first of all, ask how long the offer is made available. See if they'll negotiate cash for keys. I think the cash for keys amounts you can typically get on the lower end, on the lowest end, $1,500. But you can get cash for keys amounts that get closer to $10,000. Rare, but you can get them. And just evaluate. And then the other thing that you really need to know is, what's the move out date? What's the anticipated move out date? Because typically a servicer will offer more money if you move out sooner. In order to move out later, you're going to have to give a little bit on the money. So make sure that you understand what the move out date is, what the amount of money that it is you're going to get, and how much time it is available to have that offer made available to you. And they'll send you a judgment to approve, and then just understand when your move out date is. It might be a date certain, or it might be a date from a triggering event in the docket. So just make sure you get all those details straight. And if you feel that it's the best financial decision for you, go ahead and do it. It's certainly a good way to cut losses.
Thanks. And I think I may have misread the question. Stipulated judgment is offered without a waiver of deficiency.
Oh, yeah, that doesn't happen as often. I'll say this. A stipulated offer without deficiency, I don't know that a borrower is really getting much out of that. Especially if litigation has either just started or is ongoing. Look, they're basically asking you to give them everything you want. Well, logic suggests, well, okay, I'd be willing to do that, but what are you going to give me in return? If they don't offer cash for keys in return, I don't know that that's an offer that I would take. I think almost it would actually, frankly, be better to wait out the foreclosure process. Make sure you participate in the foreclosure process so it lasts as long as possible. Then when it's time to move out, take advantage of the time without having to pay the housing expenses. So if you get one of those, I would really advise that you negotiate hard to try to get something out of it before you agree to it, because I'm not necessarily sure that a borrower is going to get much benefit. We talked about, is your loan a federally backed loan or not? Here's how you figure these out. Is my loan an FHA loan? Most borrowers will know that. Most borrowers will know whether or not they have an FHA loan or not. The biggest ways you look at it is you consult the note mortgage. The FHA requires actually specific note mortgage language. You'll see multi-state FHA fixed note right down here often. The later forms, by the way, will actually incorporate the HUG regulations in the language. It's in the fine print. but it's actually in both the note and mortgage, but it's actually some really interesting questions there. But generally, you're talking about forms from 2016 and later. You can also look at the mortgage statement. Are they being charged for private mortgage insurance? Something that's come up lately. Can FHA loan lose its protected status? Yes, it can, but it has to be a loan that's sold under the Distressed Asset Stabilization Program, or DARP. Okay, there's a number of loans that fall under this. It's not a massive number, but essentially the long and short of this program is, in order to protect the insurance fund that is used for the federal government, they have this program that these servicers can basically sell off these loans to make sure that the federal insurance fund doesn't go under. This can be really, these are rare. I think I've only come across maybe 2 or 3 of them, but just know that it is possible for an FHA loan to lose its status. VA, real easy. Generally, this notice is right above the signature. Department of Veteran Affairs regulations, and actually incorporates VA regulations as part of the promissory note itself. Those are pretty easy to find. USDA loans, they're also pretty easy because they're so different. The note form is different. The loss mitigation is different. So you don't ask for a modification, it's a reamortization. They don't actually review you for affordability. It's just them basically figuring out if they're willing to reamortize you. Those can happen over the phone. They don't have to happen in written form, but just understand the form's going to be completely different. Generally, if they're being sued, it's going to be the Department of Agriculture or the Rural Housing Service. Fannie Mae and Freddie Mac, these are a little bit more difficult to figure out. They have these 2 search engines, and they're great, except the information needs to be entered exactly correctly for accurate response. And when I mean correctly, I mean it's however it was inputted in by Fannie Mae or Freddie Mac. Generally, you're going to need the borrower name, the property address, and the last for the social. But look these up to see if potentially it's a Fannie Mae or Freddie Mac loan. They'll say, look, it might be that Fannie Mae owns your loan. They sort of hedge their bets a little bit. If your loan does come up under one of these 2, then you're a government-sponsored enterprise loan. Now, COVID-19 forbearances and foreclosure. These are the most important stuff here. CARES Act from March. It issued a couple really important things for homeowners. A borrower can request an initial forbearance of 6 months. It can be extended for as long as 12 months. It's at the borrower's option, okay? The borrower has to request it specifically, but the servicer can't deny it if it hasn't already been requested, and as long as it's requested before the deadline passes, and we'll talk about the deadlines here in a second. You don't have to show any hardship, okay? But what it is that this forbearance lasts 6 months, and before the end of that 6 months, you just have to ask for it to be extended to 12, and then you get the full 12 months of forbearance, okay? You hear the words forbearances and moratoria used close to one another. Moratoria is a stay, and the CARES Act issues a moratoria, cannot file, seek judgment, sale, or eviction during the moratorium. I think there's some wiggle room in there for certain servicers if they want to push forward, but most people are treating this as a complete stay. Now, if you have a borrower who wants a forbearance or needs to know when the moratorium ends, generally, all these moratoriums last through March 31st. The forbearance deadlines generally last through March 31st, okay? Fannie and Freddie have actually not extended yet through March 31st. Their moratorium currently ends on February 28th. And I think there's some funky language on the Department of Agriculture that suggests that maybe under certain loans, you might have to request a forbearance by February 28th. And actually, if you have a direct loan with them, you can actually ask for it for up to 2 years. But the long and short of it is that if somebody hasn't initially requested a forbearance under CARES Act, they still can do so. They just have to request it before March 31st. They would still be eligible for that full 6 month and then 12-month forbearance. We're seeing more and more of these 30 and 90-day reviews. So basically, these are servicers that are saying, well, look, we want to just sort of revisit things every 30 days or every 60 days or every 90 days. They just say, hey, let's revisit it. Let's see if your situation has changed. These are kind of misleading, okay? And they can make a borrower believe that their forbearance plan is ended. If somebody has requested 6 months, they get 6 months, period. If they requested an additional 6 months, they get an additional 6 months, period. It doesn't matter if they're doing 30-day reviews or 90-day reviews. They can check in all they want, okay? But if they have that 6-month period, they're entitled to it. There are certain servicers that are getting a little bit more misleading on this than others, sort of suggesting that, hey, let's take another look. Maybe you want to apply for a loan modification. The borrower needs to know that if they ask for 6 months, they get 6 months. It doesn't matter whether or not they're doing these reviews. These are pretty sneaky, so be on the lookout for them.
Thanks, Mark. And Christopher Peck, who
Mhm.
runs the foreclosure settlement program at the Second Judicial District Court, did let us know in the comments that FHFA did extend to 3/31 yesterday.
Okay,
So
good.
thanks,
Okay,
Chris.
thanks, Chris. I appreciate that. This is a moving target, and goodness knows I've been paying attention to the press releases in the media rooms of all these servicers almost every day. So look, if your loan was current before the forbearance period, here's a nice little thing. The servicer now has to report that credit as current during the forbearance period. Generally, if you have a forbearance, the general rule is that they can report the credit as to credit bureaus as behind. If somebody is in a COVID-19 forbearance, it is not supposed to be reported to their credit as somebody being behind. This is a big deal and a really, really good thing. So it's a nice little thing that really encourages people to try to get into these forbearances. Now, what happens after the forbearance period ends? Okay, no lump sum is required. Okay, under any of these federal ones. Okay, the servicer and the borrower communicate about what happens, but there is no lump sum requirement. Okay, exactly what happens though depends on what type of loan you have. The FHA actually, if this is a quote unquote truly COVID-related hardship, so somebody fell behind during COVID and that the default didn't predate COVID by a significant amount, they can actually receive what's called a standalone partial claim, which is basically they took all that money, they defer it to the end, and they actually do restart payments the way they did before. But for everyone else, they're taking a look at a repayment plan to see what could possibly be afforded under a repayment plan or a loan modification. VA is just going straight to that, repayment plan and loan modification. The USDA is actually determining whether or not somebody can first qualify for repayment. If they can't, they go into sort of traditional loss mitigation, so that's a loan modification, et cetera. Fannie Mae and Freddie Mac, they're sort of offering all of them, so to speak, repayment plans, deferred payments, loan modifications. It's sort of a case-by-case basis. But understand that there is no lump sum required. And as long as the borrower communicates with the servicer, they can find a really good option for them. Now, conventional loans, private loans, a little bit more of a mixed bag. CARES Act doesn't apply to them. So servicers can actually proceed with those foreclosure cases. A lot of them are instituting programs that do mirror the federal program. That's actually sort of one kind of nice thing we've seen from a lot of private servicers. It's definitely a case-by-case basis, but they're certainly complying with those a little bit more than we had expected. But each one's going to be different. The biggest thing is have the borrower communicate with the servicer to see what's available. One quick thing about moratoria here. We're talking about federal moratoria. States can, there's room left for states. States can and have in various places imposed foreclosure moratoria. Some of them only apply to federally backed loans, others apply to all of them. So, there is the, I guess, theoretical possibility that the state of New Mexico could impose a statewide moratoria. But so just know that those moratoria dates that we were looking at earlier, these here, those are for now. I think there's a lot of talk inside the industry as to whether or not those are going to be extended. I would say, act as if these are going to be the final deadlines until we know for sure. I've heard rumors of real long extensions from here, but for now, I'd say act as if these are going to be the final moratoria deadlines, and then your borrower is kept in the best place possible. So now let's just do a real brief foreclosure process, because if the borrower understands the process a little bit better, then they can understand exactly what they can do. Generally, if the loan's not cured within 30 days, the loan can be accelerated and foreclosure proceedings can start. Now, New Mexico is a judicial foreclosure state. This means that the bank has to file a foreclosure complaint and get a judgment before a foreclosure sale can happen. Not certain non-judicial foreclosure states, it actually kind of works the opposite way, and it requires the borrower to actually take the bank to court for like an injunction or something like that. But obviously that can happen real quickly. There are certain cases in the Deed of Trust Act that are non-judicial. We don't really see any of those, obviously, because of the nature of our practice, but just know that there are certain cases that do that. These happen in district court. The borrower has 30 days from service to answer. Common affirmative defenses and counterclaims. The biggest one is real party and interest. We have to verify that this is the party to whom the debt is actually owed. There's nothing worse than getting a judgment against somebody only to find out that they weren't the ones that can actually discharge that loan. The things to look for here: is there an endorsement? Does this party have the original note? The original note is important, okay? In a lot of ways, that note is kind of like a check. And if they lose the check, things get a little bit hairier when it comes to enforcement. So make sure that that is actually the party to whom the debt is owed. There's really interesting stuff we could talk about real party and interest, but we don't really have the time for that today. Breach of contract, did they follow all the terms of the contract? This isn't just sort of the default provisions and notices, but also for FHA or VA loans, the FHA loans that include that language and the VA loans that also include that language, they do actually incorporate all their regulations, okay? Every once in a while you'll see servicing counsels say, that's a third-party contract. You're a beneficiary to that contract. You can't enforce that as a third party. And we just point to the language of the contract that says, hey, these regulations guide and govern the relationship between the lender and me, the borrower. So no, I'm enforcing the contract we have, not some third-party contract here. So you can actually pursue a breach of contract claim there. Payment is always a defense. It's easy to prove. It's a lot of times, just be wary when somebody tells you that they've made all their payments. Make sure that they really have, because a lot of times those don't really work out quite as hopeful as well as you would hope. Inaccurate accounting can be considered wrongful foreclosure. Violations of the HLPA and UPA can be raised as affirmative defenses and counterclaims where appropriate. If they're charging excessive fees, statute of limitations, anybody who's tried the statute of limitations defenses knows that they're not as easy as maybe they might seem. And by the way, these forbearance plans are also staying the statute of limitations for various reasons, because case law says if you can't proceed on a case anyway, it's inequitable to hold the statute of limitations for that period of time against you. But there are certain cases in which statute of limitations is implicated. Remind, by the way, though, the borrower that if their case takes 6 years, that doesn't mean the statute of limitations has run, okay? Generally, the statute of limitations requires that a case be filed within 6 years of the default, okay, or of the acceleration, basically. That's something that you're going to need to rewire some of the borrowers on. Latches is basically they take too much time to do this. And then you can always actually plead equity. I like this because it gives you an opportunity to really tell your borrower's case and to explain everything that happened. Mediation, Chris, I know you're in on this. These are great programs. I believe the 11th has started now, but these are free foreclosure mediation programs at the court. I would strongly encourage any borrowers who are in foreclosure to participate in this program. Most cases are referred as soon as the complaint's filed or soon thereafter. There has to be the borrower does have to attend a workshop in order to be able to sort of stay in the program. The borrower does have to complete a loss mitigation application, which is smart, because if we're going to talk about what can be done, we need to know what the borrower can and cannot afford. The servicer goes ahead and reviews that and says, hey, we can offer you this, we can offer you that. If necessary, we set it for live mediation. Something to look out for: the servicer representative has to have settlement authority. Okay, this is somebody who has to be able to say, you know, you offer them a counteroffer and they don't have to run it up the chain. It has to be somebody who right there can say yes or no. Somebody with that power. Cases stayed. There is also private mediation available. Maybe your clients or your borrower missed the mediation program and was unable to get back in. Or maybe you're in a district that doesn't have one of these programs. Private mediation is also available. Costs are borne by the parties. I would encourage the judge to apportion that by ability to pay. Litigation, just briefly.
Sorry
yeah.
to interrupt. So another question. So when a consumer receives a loan modification, their loans are extended from 30 to 40 years, this person has noticed. So is this generally the case?
So a servicer can do that. They don't always do that. We've been seeing more and more servicers do that, take that ability. And, you know, in certain ways, you can see how this would help a homeowner. You know, if you extend payments out an additional 10 years, the monthly payments can be made a little bit more affordable in the now, so to speak. It's not a requirement, but we do see it. Sometimes, you know, they have a wide range of options available to them. Sometimes they modify within the terms of what's still of the time that's still left on the loan. So it might be they have 15 years left on the loan. Well, maybe they just change the interest rate. Maybe they defer payments and they don't have to really change the interest rate much. Another thing they can do is they can do like a stepped interest rate. So year one, the interest rate might be 2%. Year two, it might be 3%. And then years 4 and after, it might be 4%. So there are a range of options available to them. It is legitimate though, if they can extend it out to 40 years. Okay, that's something that they can do. It's not required, but if they feel that that's the best way that they can get to affordability, that is something that they can do. Just briefly about litigation, I would strongly consider sending discovery, ask for the full servicing file, correspondence is sent and received, copies of the original note mortgage, and information about the investor and owner. Some of the stuff you can get, by the way, through a notice of error and request for information. Those are nice because if the servicer doesn't comply, then technically you can actually sue them for it, and you can get damages. As a result, the damages aren't massive, but you can get a little bit of money. The servicers do take that seriously, and then depositions where necessary. But look, many cases in New Mexico end in default judgments, far too many. That's part of the reason why we put together the mediation program. Make sure all borrowers respond to the complaint. I've seen servicers try to have a husband and wife where let's say the wife files an answer that she believes is on behalf of both her and the husband, or maybe in various places they say us, but not both of them sign. I've seen a servicer actually try to get a default judgment against the one who didn't sign. Okay, so make sure that borrowers do actually respond to the complaint. Everybody who's defended, that's part of that family, actually responds to the complaint, files an answer. Look, most cases are resolved through summary judgment. If they're not resolved through loss mitigation, we don't have a ton of trials, but they do come. 15-day response time and hearing. Just briefly about in personam and in rem judgments. In personam is a personal judgment for sum of money, and in rem is just a judgment against the property clearing the borrower's title. If you're being offered an in rem judgment, understand that they are not seeking an in personam judgment anymore. There's not going to be any personal judgment, right? So that's a good thing for a borrower. They don't have to worry about deficiency. They don't have to worry about maybe declaring bankruptcy. You know, basically when they walk away, they're walking away. So sometimes you'll also see in a complaint for in rem foreclosure. That's typically when a borrower has previously declared bankruptcy. That's the servicer saying, look, we're not asking for a personal judgment. We just want the title cleared. And we're just getting to the final steps here. Sale has to be advertised for at least 4 weeks. Property goes to highest bidder. It's often an amount of a judgment credit. So we see a lot where a judgment amount might be 150. The sale price is 150, therefore nothing's left over for the borrower to owe. However, sometimes deficiency is owed afterwards. If you have an in rem judgment, there is no deficiency, but an example might be a judgment amount of $150,000. There's a sale price that's below that. There's an amount of $50,000. That's an unsecured personal judgment, okay? So you know, if they do want to execute on that, that is when the garnishment and such can kick in. There are certain protections for people who are on public benefits. This can be resolved through bankruptcy. But after the sale, special master writes a report that says, on this particular date, I sold it for this much. And if the sale price is too low, or for any other reason, people can object to the sale as long as it's within 10 business days of the report being filed. Post-sale, this will address the question we had earlier. The judge has 30 days to approve the sale. And once the judge approves that sale, this starts this 30-day redemption period. And redemption is in that 30-day period. It has to be within that 30-day period. It's really hard to get that extended. But within that 30-day period, the borrowers have an exclusive right to tender the sale price plus interest from the day of the sale at 10%. So, you know, it's just a little bit extra premium. But if the full amount's tendered in that 30-day period, the property goes back to the borrowers. That's it, no questions asked, okay? The rights are transferable, so they can be given to anyone, okay? Which includes selling it to investors. We're seeing a lot of this right now. We're getting a lot of calls about redemption rights from investors who are wanting to buy them. We're also getting calls from investors who actually buy the property and then also want to buy the redemption rights to ensure that nobody takes the property from them. So we're seeing those. They are valuable, but the value will depend on the value of the property and the amount of the sale. You know, I saw somebody sell their redemption rights for $5. Don't do that. Sell it for more than that. But the eviction proceedings can't begin until the redemption period is expired. Eviction has to start with a 3-day notice to vacate. A couple of issues that we're seeing right now with this, okay? One, we're seeing increasingly purchasers are resorting to magistrate and metropolitan court for writs of restitution. The process has typically been that somebody files a motion for writ of assistance in district court in the same case number. Most larger servicers will do that. But increasingly, we're seeing purchasers that sort of come out of the woodwork. Somebody who will just come to the property and say they own the property. And it might be and increasingly what purchasers are doing after sale is that they're actually putting it up for auction online. And so people are buying these properties online. They go to the home thinking that all they have to do is kick somebody out. We've actually had to basically talk down the sheriff who just showed up at the door and say, whoa, wait, there's a legal process here. So it could be difficult to confirm who that new property owner is, but do whatever you can to do that. They are afforded an opportunity to respond and a hearing. At the hearing, they can ask for more time if there's a legitimate basis. And you can typically find out when the sheriff's supposed to be there. Now, one quick thing before we finish up here. Some of you may have heard about a CDC, the Center for Disease Control, basically issued an eviction stay. That has been extended. However, if you're working in the foreclosure area, know that the CDC specifically exempted evictions that come from foreclosure, okay? So that does not actually apply. I like to argue that the principles still apply because look, forcing somebody out of their home, forcing somebody out of a rental property, in a lot of ways, from a public health perspective, it's not any different. So just be aware that, you can't wave around the CDC order. This is the flow chart post-judgment, just sort of see it visually. There's a lot of things that have to happen. So make sure that the borrower understands that if judgment's entered against them, that's not great, but there's time to be able to get their affairs in order, and we would certainly encourage them to take advantage of that time. So, final thoughts: we don't know how bad the tidal wave is going to be. I think there's going to be many more foreclosure cases in the next 2 to 3 years. If you haven't requested forbearance, do so. Keep the lines of communication open. Complete those applications as soon as possible, and reapply, by the way, when you have a change in circumstances. And make sure that the borrower participates in any litigation. As long as they're participating in litigation, the borrower has time to figure this stuff out, but they have to participate in the litigation. So, any questions for anybody? Obviously, that's sort of contact information.
Thanks so much, Mark. Juan also put in the chat the information for United South Broadway as well. And so I just also want to emphasize the housing counseling that they provide. That's a really important resource for people who are trying to figure out how to deal with falling behind in a mortgage or potentially falling behind on a mortgage, how they can work with the mortgage servicer. And so I'll give folks a couple more minutes to type questions if they have them. Also, like I said, feel free to raise your hand and I'll unmute you. Thanks again, Mark, for being part of this series and for all of this information. The Access to Justice Commission hosts these webinars regularly, and so we want to make sure that we're getting information about legal topics that are important to you all out. So if you have additional topics you would like to see, you can contact me. I will put my contact information in the chat as well. And Juan, you had your hand up. Did you want to say something?
Oh, that was a mistake. Thanks, Grace.
No worries.
Just to reiterate, I really appreciate all the work everyone's doing. We don't know how long this is going to last. I think we're all scared that in the next few years that more of these are going to come. I appreciate the fact that everybody's preparing for that to make sure they know how to counsel people appropriately. But the biggest thing is that if it's somebody who hasn't already requested a forbearance, go ahead and do so if it would be good for them, because that can give them an additional 6 months to a year to try to figure things out financially. And sometimes that can be all the difference for not just a borrower, but for the home that they support. So.
Sure. And Mark, we do have a question. It looks like, so are any landlords able to get a 6-month forbearance so they can give their tenants more time to pay back arrears in rent without the landlord's credit?
Yes. If it's federally backed, the FHA is specifically addressing this. Yes. And that's sort of an interesting sort of place, by the way. The federal moratoria, by the way, also includes anybody who's renting a property from a landlord who is paying in on an FHA loan, okay? So it does, those protections do essentially extend to them. It can be a little bit more difficult to get that information, but yes. Now, you might run into a few issues with what's called the owner-occupied requirement. Sometimes certain programs limit the relief to properties that are considered owner-occupied. So it's the owner's primary residence and they live in there. You might run into some issues there, but FHA is providing some relief for those who are renting those properties out. I would encourage them to contact their servicer or the FHA. Absolutely.
Great. Thanks, Mark. Juan also put a link in the chat where homeowners can apply to receive mortgage assistance help through HomeWise here in New Mexico. And I will also send that out with the materials. I'll send the slides as well as a link to the recording of this webinar out to everyone who attended and who registered. And I'll also send it out on our Access to Justice Commission lists. So you should be able to receive it one of those ways. And again, like I said, please let me know if you have any other topics that you are seeing come up in your communities and you'd like us to provide more information about through a webinar. My contact information is in the chat. You'll also have it when I email you the slides and information. Thank you all so much for being here today, and thank you all so much for your work. Please take care and be safe, everyone. Thank you.